the preparation of the final accounts. One of the relevant standards you'll be quizzed or you'll be examined on as one of the additional informations will be IPSAS 3. Now, IPSAS 3, I hope you can hear me, please. Can I get feedback if you can hear me?
Yes, please.
Okay. So, IPSAS 3 is on accounting policies, changes in accounting estimates, and errors. The objective of this standard here is to describe the criteria that one will need to in order to select an accounting policy, in order to change an accounting policy. What is the criteria involved? And also, you're going to look at the accounting treatment for these as well, and then the disclosures in relating to changes in accounting policies, changes in accounting estimates, and then correction of errors. So this standard is divided into three. We have the accounting policy, we have the changes in accounting estimate, and then we have the correction of errors. So we are going to look at all this for today. We'll first start with the first one. The first thing I have to let you know is that this topic as well, they can ask you theory questions as well. So all the theory from these standards have been examined before, have been examined numerous times, they have been examined. So make sure you also know some of the theoretical concepts from the standard as well. Let's start with the accounting policy. Now, when you talk of accounting policy, you are basically referring to the rule or the treatment in respect of a particular item that merits its recognition in a financial statement. Going into the standard will define accounting policy as the specific principles, the basis, the conventions, the rules, and then practices that an entity applies in the preparation and presenting of the financial statement. Now, how do an entity formulate an accounting policy? You need to know the guiding principles, has been examined before in the past question. The guiding principles for formulating accounting policy. And then here we say the guiding principle is just two. Then we say the guiding principle is that the results is that the policy should result in information. That is, so we look at two major information. Number one is for relevance for decision making, and number two is reliability of the financial statement. Then the standard moves on to explain what it means by reliability. Now, reliability is referring to faithful representation. Reliability number one is about faithful representation. Is the information faithfully represented in the financial statement in terms of the position, in terms of the performance, in terms of the cash flow? Is the information faithfully represented? The second one relates to the economic substance of it. That's what we normally refer to in accounting as substance over form. So we're going to look at the economic substance of the transaction and not its legal representation. That's substance over form. This is also a reflection of the information being relevant or being reliable. And next is neutral. Neutral here means that it should be free from any potential bias as well. Then prudent. And then next is it should be complete. And then lastly, when you choose an accounting policy, you should be consistent in its use. So the last one is about consistency. This is the guiding principles, which has been examined before in the past question. So let's look at selection of accounting policy. How do we select an accounting policy? The first step is that if you have an accounting policy relating to a particular treatment which has been covered by an IPSAS, then you're going to use that particular accounting policy. So if you have a public sector accounting standard relating to a particular treatment, like in a case whereby it relates to property, plant and equipment, we have a standard for it, IPSAS 17. You apply that rule. If it relates to intangible asset, it's IPSAS 31. So you should know the particular IPSAS to apply for that particular transaction. That's in the case whereby the IPSAS provide for it. So first one is if the IPSA provide for it, then select that particular IPSA in relating to that particular transaction. Next one is in case we don't have an IPSA on a particular issue, how should you go about it? So here we say management, as management, we will use management judgment. We say this management judgment will be influenced by certain factors. So bear in mind, these ones are factors that will influence our choice of falling on other measurements. So what are some of the factors? Number one that it must first meet the guiding principle. What are the guiding principles? We made mention that the guiding principle are two: relevance and then what reliability. So we have already explained these two. So it must first meet the guiding principle, which is what relevance to the decision needs of the users, and then lastly, reliability of the financial statement. The next one is that is the actual, in the case where you don't have an EPSA, what are you going to do? I will say you fall on similar IPSAS, requirements of similar IPSAS in alignment with the issue. So you may be having an issue which may not be having an IPSA on its own, but one particular IPSA may account for it because of similarities. So if there are similarities in that regard, then make sure you use that similar IPSA to account for it. So that's with the first one, whereby you want to follow the requirements in IPSA in dealing with a similar issue. So this one talks about similarity. The next one is that in a case whereby you may not have any specific IPSA, so you don't have any specific IPSA, it may not be similar, then you can maybe rely on the recognition and measurement requirement. Recognition and measurement requirement provided by any IPSA, we may be having some other jurisdictional IPSAs that people may be using. If you have any standard which still relates to it, you can fall on it, that. And then the last one is if you're in an industry, you may be having a way you go about it. You have a way you undertake your activities. So if you have an established practice in that particular industry, make sure you rely on that established practice. So these are the selection of accounting policy, what you do. So remember that if you have an applicable standard, follow the applicable standard. If you don't have any applicable standard, you use management judgment. But first, before you can use management judgment, you must meet the two guiding principles, which is about the relevance of decision making and reliability of the financial statement. Then the additional is that you use similar IPSAS to account for that particular transaction. If the similar IPSA is not there, fall on the conceptual framework. Fall on the conceptual framework. The recognition measurement criteria are also in the concept. Fall on the conceptual framework. If the conceptual framework still doesn't have, you may be having an established practice because you are located in a particular industry. Then you use the industry rule in that respect. So this for selection of accounting policy. The next one is what is the conditions? What will warrant you to change an accounting policy? You see, what will warrant you to change an accounting policy is two. Number one is that it should be required by IPSA. I don't know if you have heard, but the revenue IPSAS will be changed next year. Next year, we'll be having new revenue IPSAS. So all the revenue IPSAS you'll be having will be cancelled. All the revenue IPSAS will be cancelled. We'll be having a new IPSA, which will be, it's already in force. Just that it has not, the effective date is not starting this particular year. So we don't expect ICAG to examine us on the new revenue IPSA. So bear in mind that revenue will change certain things that we do the previous IPSAS we're having for revenue. That was revenue from exchange transaction and revenue from non-exchange transaction. It will change how you go about the transactions in that respect. So you can see that here, a new IPSA here can change what you are doing previously. That's what I'm saying is when it's required by IPSA. So this one is mostly mandatory. The first point is mostly mandatory. And the second one is more voluntary. That's you are the one changing it. But the condition that must inform you to change is that if to result in you providing a reliable and a more relevant information in respect of the particular transaction and its effect, in respect of that particular transaction and its effect on the financial statement, then you can go ahead and go about it. So remember, the first one is that when it's required by another IPSA. In a case whereby mostly we have a new IPSA, which may be coming to replace an old one. Or maybe having a provision in an IPSA. Most of the time we make an amendment in an IPSA. So if there is an amendment in one particular provision of an IPSA, which may change the corresponding IPSA, you also work on it accordingly. So conditions. That's with the conditions. Any question on that before we go to the accounting treatment? Is there a question? Okay. If there's no question, let's proceed with the treatment. Treatment of changes in accounting policy. Treatment of changes in accounting policy. Now, what's the accounting treatment? How do we account for when we have a change in accounting policy? So the first one is that if the change is warranted by an IPSA, remember the first point we said over here that an IPSA, when you're having a new IPSA, it can change what you previously do. So if the changes here is warranted by a new IPSA, then that IPSA will definitely be having transition requirements. Whenever you have a new IPSA replacing an old one, they'll always give you how you are supposed to transition to the new one. So you make sure you follow that pronouncement transition requirement. Follow that transition requirement enshrined by the new IPSA. Second one is that in a case whereby there is no transition requirement, what do you do? Or probably you are doing a change because the change is a voluntary change. And we say the change will be voluntary change when the condition is that here the results will provide what a reliable and a more relevant information in respect of the effect of the transaction. So yeah, if in the case whereby it is voluntary, what we do here is that we say here you apply the new accounting policy retrospectively. Retrospecting. And what's the meaning of retrospecting? Retrospecting means going back to previous accounting periods and restating equity and its comparatives. So you're going to go back to your prior period. So if you are, for instance, in 2020, let's say financial statement for 2024, you have to go back to prior financial statement 2023. In some instances, they may even go back for 3 years because they want to account for the effect of the change in that 3 years. Some will say go for 5 years. So that's with the second option. So in the case whereby you don't have a pronouncement transition requirement, or you are the one bringing the change, then make sure that you apply that change retrospectively. Retrospectively here means you're going back to previous accounting year and then you're going to reinstate your equity and its comparatives. Then the third one is that here, if the reinstatement is impracticable, that means you can't go back to the previous accounting period to account for them. That means it's impracticable. In the case whereby it's impracticable, then we say that yeah, just look at the cumulative effect of that new policy. Look at the cumulative effect and adjust it to your net assets or equity. This is what most people will usually do. In practice, you'll be seeing more of this. You just pick the cumulative effect of the particular change and you adjust it to your net assets or equity, what we normally refer to as statement of net assets. In the case whereby it only affects your surplus or deficit, you just adjust it to your statement of accumulated fund. So that's that. And then the last one is that in a case where you have exhausted all the first three, and you have realized that still you can't determine the cumulative effect. Cumulative effect means maybe for the comparative year looking at the retrospective you are going 3 years retrospective. So you can know the cumulative effect by adding all the effects that it will have on the financial statement. You can add the effect. Yeah. So in the instance in which you can't find the cumulative effect of that particular transaction, then we say don't bother yourself, just apply it in the current year. And this is what we refer to as prospectively. You apply that change prospectively. So in year, you only do this when you have exhausted the first three. You only do this when you have exhausted the first three. Is there a question on changing accounting policy? So we are done with the theory on changing accounting policy. From the definition, guiding principle, its selection, what will warrant you to change, and then the treatment. Is there a question?
No, sir.
Okay. If that's the case, then let's move to the next subtopic under IPSAS 3, which is changes in accounting estimate. Changes in accounting estimate. As the name suggests, here you're making some changes in terms of what amount of assets and then liabilities. So when we talk of a change in an accounting estimate, basically means you're making a change in the current amount of an asset and liabilities. What will result in these changes in the current amount? When you change your useful life of the assets, when you revise your provision, you always make provision. Take 20%, take 5%, you're making provision on the rest. So whenever you make a revision of your provision estimate, it also falls on that. And any revisions you make in respect of your receivables as well also calls for that. And any revisions you make in the current amount of your assets and liabilities will relate to a change in accounting estimate. Now, with change in accounting estimate, we say you have to account for it. And we're looking at the accounting treatment straightforward. We say you have to account for a change in accounting estimate prospectively. What's the meaning of prospectively? You have to really understand this because when we get to the practical, we will be applying more of this. Prospectively here means current and future. It means now. Apply the change now and future. And because of this made the meaning of prospectively. If the change occurs at the end of the year, let's say we have 5 years. You are dealing with maybe an asset. The asset has maybe a useful life of 10 years. You revise it to 5 years. And you say the change occurred at the end of year two. If the change occurred at the end of year two, by implication means you apply the change in year two. Someone will say, oh, at the end of year two means year two has elapsed, so we should apply the change in year three. No, the standard is saying prospectively. Prospectively means now and future. So if it is at the end, even if you are 31st December, you still apply the change in that year. Please, are you okay with that? When we say prospectively, it means apply the change now and future. In this context, in this standard, what it means, the English will say prospectively means future, but in this context, prospectively here means now and future. So if the change in accounting estimate occurs, let's say at the end of year two, bear in mind that you apply the change in year two. Don't tell me that the change will start in year three. No, it will be year two because it occurred at the end. Even if it's at the end, you have 1 day left to move to the next year. You still have to apply the change in that year. This is where some people get confused. That's why I'm stressing more on it. Prospectively here means what? Now and future. The now we are referring to it here is that even if the change occurs 31st December of let's say 2022, you apply that change in 2022 as if you are starting from the beginning of the year. Please, are you okay? Please, do you understand the prospectively? I think I've explained enough.
Yes, please.
Okay. And let's go to correction of prior period error. As you say, we are humans, and then with humans, you will definitely make errors. So errors are bound to happen. So when errors occur, what do? You definitely have to what, correct these errors. So yeah, we have two classes of errors. And what are these two classes of error? We have an error we call material error and immaterial error. This one is just based on the context of the or the nature of the error. When we talk of material error in this context, the material error is referring to errors that relates to prior period. Prior period here means if I'm in 2025, say the prior year before 2025, that will be 2024. So if you have an error affecting prior period, they deem it as material error. But if the error occurs in a particular current year, then we say it's immaterial. Just account for it in that year. So that's based on the nature. It doesn't mean anything complex. It's just based on the nature. That's why we can have a classification as material error and an immaterial error. So yeah, the treatment is that if the error is material, as the name suggests, as I've given explanation, the material error here is referring to error which relates to prior period. So you're in 2025, but you made an error in 2024. So this one is a prior period error. How do you go about it? If it's a prior period error, we say well, you should do what we call retrospective reinstatement. Retrospective here means going back. You have already established that when you're doing the accounting policy. Retrospective here means going back. So mean go back to that year that you made the error and effect the change in that year. That's the meaning of retrospective reinstatement. Yeah, with the retrospective reinstatement, we'll just look at the cumulative effect and then we'll adjust it to the appropriate treatment. The cumulative effect will account for the retrospective reinstatement they are doing. So some can just go straight and just account for the cumulative effect on the item. And that will solve the error. But in a case whereby the error relates to your current reporting period, if it relates to this year, and then by God's grace, you're able to identify it within the year, we say just go back and then correct that error in that year. So yeah, when an error is deemed material, meaning it relates to prior period, make sure you do what we call retrospective reinstatement. However, if the error is just relating to this year, count for that error, correct that error in your current period. And that's all. If we have a question, so we are done with all the theoretical concepts, and then this, all the theoretical concepts. And then if there is a question, let me know before we start solving the practical questions. Yes, Hannah, you can go ahead. If you have this up, you can go ahead. Is there a question?
Hello.
Yeah, go ahead.
Hello. Yeah. Please, mine is not a question, but probably something that we need to know. Like, how would you identify when a question is given? How would you identify that this relates to error, this relates to estimate, and this relates to policies?
Okay. So wait. Okay, let me start from policy. With a policy, when you see a change in a policy, so for instance, if you are using weighted average, you move to FIFO, that's a clearly a policy. If probably you are having a new standard, that's clearly an accounting policy. Um, I think Kaplan also identified three things to, though this one is more into FR, but let me add it. The Kaplan identified three major things to look out for when it comes to a policy. It looks at, if my memory serves me right, it looks like the measurement, it looks like the recognition, and then the presentation. Yeah, these three. That's going deeper into FR. So if there is a change in respect of presentation, change in respect of the measurement, change in respect of the selection of the item, then it will warrant a change in accounting policy. That's for accounting policy, specifically accounting policy. But with accounting estimates, deals with the carrying amount. Anything that will cause your carrying amount to change. So depreciation. When you change your depreciation, the standard specifically said that Straight line to reducing balance is not a change in accounting policy, but it's rather a change in an estimate because it results in the change in the figure of the amount. So the standard clearly outlined that. That would be a little bit key. Some people may think it may be a policy because straight line is definitely a policy, but the standard has clearly identified that if you're moving from straight line to reducing balance or reducing balance to straight line, that one is clearly an estimate. And then if you have anything, maybe a bad debt provision, these ones are basically a change in accounting estimate. Did I attempt your question? I think for error there, you will definitely see it in the question. If you have made an error, they'll tell you that you made an error in prior period, you made an error this year. You'll definitely see it for errors. I think the issue may basically be for changing an accounting policy and changing the estimate. Are you fine?
Sure. Yes, please. I'm fine. I'm fine.
Okay.
Thank you very much.
You're welcome. Any other question?
Hello.
Yes, please.
Please, pertaining to the classics of error, the material error and immaterial error.
Yes,
You
please.
made a statement that okay. You made a statement that if the errors occurred pertaining to prior periods error, that is the material error, we should apply a retrospective
Reinstatement.
we should reinstatement. Yeah. And for the immaterial is the prospective or I didn't
Okay.
get that side.
More like the immaterial will be more like in just account for it in the year. So you can
In the
say
year, the current year.
you can say prospective, yeah, in the current year.
Okay. Mm,
Any other?
thank you.
You're welcome. Can we proceed now? Or there's additional questions someone would like to ask? Okay. Let's start with question one. Can we get someone to read for us?
Question
Okay.
one.
Yeah.
Okay. A non-current asset was purchased for 200,000 2 years ago when its expected economic life was 10 years and its expected residual value was nil. The asset is being depreciated by straight line method. A review of the non-current asset at the end of the year. A review of current assets. A review of no, a review of accounting policy or change in accounting estimate. Explain with workings how the above case would be accounted for.
Yeah, okay. Thank you very much. So let's start with the A. The A is theoretical. To identify if it's an accounting policy or a change in accounting estimate. So what do you think? Is it a change in accounting policy or a change in accounting estimate? Can you share your views? Yeah, hands up. Go ahead. Yeah, go ahead, please.
Okay. I'm I'm thinking, in my own opinion, I think it's accounting change in accounting estimate because revalue of the period or the term will reducing the term from 10 years to the 4 years will affect the amounts, the carrying amounts. That's my view, sir.
Okay, that's true. So yeah, it's clearly a change in accounting estimate. Reason being, change in useful life will result in a change in the depreciation estimate. As the standard says, anything which will cause your depreciation estimate to change is a change in accounting policy and accounting estimate. So this is a change in accounting estimate. That's true. Any other viewpoints? Any disagreement? Or do you agree? Okay, so that's change in accounting estimate. Let's go to the B. The B is telling us to explain with questions. Whenever you see explain with questions here, you need to do some form of elaboration. Don't go straight into solving the question. Otherwise, you lose the marks associated with the explanation. So just write something brief before you solve. So what are the brief thing you can say? You can tell us which standard it relates to. Let us know the standard it relates to. Number two, the type of maybe what's the transaction, what does it relate to in the standard? Let us know what it relates to itself. Then most importantly, the measurement rule. Measurement rule. So using this approach, if you are doing the explanation, just tell us that according to IPSAS 13, maybe this question falls under the ambit of IPSAS 13, accounting policies, changes in accounting estimates, and errors. And tell us that it relates specifically to a change in accounting estimate. Then tell us the accounting treatment in this case. Remember we say change in accounting estimate. What do? You account for it what prospectively, and I explain it prospectively, meaning what now and future, current year and future. So yeah, let's identify where did the change occur? When did the change occur? When did the change occur? Anyone? Go and check the question. When did the change occur?
In the second year.
So you clearly that's true. They said a review of the non-current assets at the end of year two. So the change occurred at the end of year two. Now this is what I'll tell you. If you see at the end of year two, don't assume that the change will be applied next year. No, that's wrong. Remember I told that even if it's at 31st December, you still have to apply the change as if it was at the beginning of the year. So yeah, although the change or occurred at the end of year two, you actually apply the change in year two. So yeah, bear in mind that in this question you have to apply it in the year two. Don't think because it said at the end. So at the end, year two has elapsed, then to start from year three. No, that's big wrong. It will definitely be in year two. So in going to our solution, let's start with the solution. Yeah, what we need to do is to bring the cost of the assets. So we're given the cost of the asset to be 200,000. Now we need to get the current amount before the change. We have to get a current amount before that change. So how do we get a current amount? Now bear in mind, if you are looking for current amounts, you are going to look for current amounts here at the beginning of year two, because we said that yeah, the change will start in year two. You apply the change in year two because prospectively, even if it's at the end of the year, you will do it as if it's at the beginning of the year. I explained that. So yeah, we need to find the current amount at year two beginning. So with that means we need to calculate for depreciation. How do we get our depreciation? Depreciation will be the cost of the assets divisible by the useful life. So the cost of the asset was 20,000, 200,000, sorry. So let me bring the extra zero. Then divisible by the number of years, the useful life. So what's the useful life of the asset? The initial one. What's the initial useful life of the asset?
10 years. 10 years.
So we bring the 10 years and then we calculate for that. What do we get?
40,000.
Are you sure? Divided by 10, oh, isn't 20,000?
20,000. Yeah, 20,000.
So this will be 20,000. So this will be 20,000. Then we'll less it to get the current amount. So this will be the current amount at year two beginning. So what would that be? 180 or
Yeah,
Yes.
180,000.
which is which? Is it 80,000 or 180?
180,000.
Okay. So this will be the current amount of the asset at year two beginning. So yeah, we said we are going to apply the change in year two, even though the question said it occurred at the end. Once it's at the end, it's still part of year two. So we apply the change in year two. So how do we do that? We will now have to calculate for our new depreciation. We need to calculate for new depreciation. And to get a new depreciation, it should just be the the value that we have, the current amount that we have at that date. So the current amount, then you divide by the remaining useful life. So in doing that, the new depreciation here will be the current amount. The current amount here we had was 180,000. We'll divide it by the remaining useful life. Now, what's the remaining useful life? Question. What's the remaining? I mean, what would be our remaining useful life?
5.
5. How many beyond
4.
5?
4.
How many
Okay.
beyond 5?
Uh,
Or 4?
the
It will be, I think, 5.
Why 5?
5 because they said the assets instead of 10 years, it should rather be 6. And
Mm-hmm.
we've already calculated for 1 year depreciation. So it will be left with 5 years that we are going to consider because that will be the
That's
remaining.
correct. So
Yeah.
that's correct. It's going to be 5 years. And the explanation again is the same thing. What I've said. So yeah, the useful life of the assets. They give you the new one. They say the new one is now what? 6 years. The new one is now 6 years. So if you are using 6 years, that will be 6 years over here. Then less how many years you have charged depreciation for. If you check in this question, we only charge depreciation for just 1 year. So far with our solution, we have charged it for just 1 year. So we just subtract one from it. That will be 5 years. So that what will be our answer? The new depreciation. 180,000 divided by 5. What are you get?
36,000.
36,000. And here we'll subtract it from, let's look for our current amounts now. Current amount at year two ending. So at the end of year two, let me do it that way. At the end of year two. So that will definitely be the 180 minus the new depreciation now, which is 36,000. What are you going to get?
144,000.
144,000. That's all. So if you are to present for year two, to do a statement, we didn't really say it, how would the above be accounted for? So let me just add it. If you are to do the statements, we'll do statements of financial performance for year or second year ended. They didn't give us a date, so I'm just doing second year ended. Then here what we need to bring in be the year two depreciation. So depreciation for year two. And that was clearly 36,000. So we bring the 36,000 there. Then we come to statements of financial position. So position, assets. Yes, second year ended. And here what we need to bring is our PPE figure, which will be under non-current assets. So under non-current assets, we'll record PPE, which will be the current amount we have here, 144,000. So this is for question one. Any question, please? If you have a question, let me know. Let me see question two.
Yes, please.
Okay, so question two. Any reader?
Question 2. In the year 2019, 8 billion Ghana cedis was spent in acquiring equipment to boost government projects. However, these transactions were recognized in the accounts as goods and services expenditure in the year 2019. Equipment has a useful life of 10 years. The current accounting period ends on 31st December 2020, and this error has since not been rectified. Required, in accordance with IPSAS 3 accounting policy, changes in accounting estimates and errors, prepare extracts of financial statements for 31st December 2020 to account for the above transaction.
Okay, thank you very much. So the first question I have to ask the class, you have to identify where to fall under. Is it an accounting policy? Is it a change in accounting estimate? Or is it an error? Who will help us? Hmm. Okay, in the comments, someone is saying it's an error. Who else? Yeah, the line is up. Go ahead.
So please, please, I think it's an error
Why?
because it was an asset and they recognize it in their account as goods and service expenditure.
Okay, yeah, that's true. So it's an asset. We're supposed to record it as an asset, but they recorded it as what? Goods and services expenditure. They record it as an expense in their books. So that's clearly an error, which we need to rectify. So yeah, this error, remember we said we had two types of errors. We have the material and the immaterial. Material meaning prior period, immaterial meaning this year. So what does this one say? Is it prior period or is it material or immaterial?
I think it's immaterial
Why?
because the accounting period ends on 31st December 2020. That's the current accounting period
And the error occurred when?
in 2019.
So is it prior period or this year?
Mm, it's
Proud
trial
period.
period.
So once you have 2019 and your current year is 2020, that's definitely a prior period there. So it's rather a material error. Do you get it?
Okay.
Okay. So let's go into the solution. So yeah, we have to identify the statements which will house the correction errors. Now, the statement which will house we correcting the error will affect, this will affect your surplus or deficit. You're in public sector, so let me use the right terminologies. In fact, they'll say profit to affect your profits, right? This will have affected your profits, right? But you can't go back to your financial statement to correct. So where do you go to? You fall on your surplus or deficit. The totality of the surplus or deficit is recorded in accumulated fund. So we need to prepare statement of accumulated fund to account for the error. So here we'll open so question 2. Our first statement of accumulated fund for 31st December for our current year 2020. Then we bring the currency side, Ghana City. So let me just give an overview of how the statement of accumulated fund is. You first have an opening balance. It's similar to what we call in FR retained earnings. So if it's FR, you have sent it to retained earnings. So yeah, we are saying it is accumulated fund. Yeah, so because it's public sector, it will relate to the accumulated fund because accumulated fund will house the summation of all your surplus and deficits over the period. So you first bring your balance, opening balance of your accumulated fund. In this question, we're not given, so dash. Then you will now correct the error. So we call it trial period error. We will now correct the error. When you correct the error, then you get a new balance. We call that balance restated balance. Restated balance. Now, in correcting the error, we have to look at the effect on the profits. Bear in mind, accumulated fund is the surplus or deficit over the period. So, if you are correcting the error, what will have been the effect of it? So, first error we need to correct will be the motor vehicle. Was it motor vehicle or equipment? Equipment, yeah. So, you have to look at the equipment costs. Now, we have to correct this error, the equipment cost, which was what? 8 billion. So, let me bring million on top so that I can bring 8,000 here. It's 8 billion. So yeah, this 8,000 will correct the error in statement of accumulated fund. Now this 8,000 you should be able to identify whether the 8,000 are we to add that to the balance of accumulated fund or we are to less. So that's the question you have to ask yourself. Are you going to add
Uh,
back to correct or you are supposed to less to correct?
I
We
think
were.
we should. I think we should. Originally the goods and service was originally recorded as an expense, which has been less from their revenue. So if we are correcting it, it means that it has already been subtracted. So now we should add it.
Okay, so that's true. So what you are saying in summary means that the error understated our profit. So if you want to correct it back, we should what? Add it back to bring it back to its original position, right?
Yes, please.
So that's true. That's true. So yeah, we'll just add it. So I'll leave it like that. 8,000, just the positive figure. Now bear in mind that equipment you need to calculate for what? Depreciation. So the effect is two. It will affect the cost and depreciation. So we are done with the equipment cost. The next thing we need to focus on is the depreciation. So we have to calculate for depreciation for this item of equipment. How do we calculate for depreciation? We bring the cost which is what the 8 billion divisible by the useful life. What's the useful life in this case? It's 12 here,
ten,
right?
10
10
years.
years. Yeah. So divided by 10 years. So that will give us 800. Oh,
Yeah, yeah, 0.8.
yeah. So we let's learn it to know the effects of the prior period error. That will be 7,200. Ordinarily, when you get the effect, you add the effect to the opening balance. And we go balance we call restated balance. In this question, we're not given the opening balance, so there's no need for me to worry myself with that. We are doing an extract, so it's not the totality of the statement you have. So we'll have added the 7,200 to the opening balance to give us what we call restated balance. So when you have done this, you have corrected the error. You have corrected the error. But you won't get the full marks. Why? Let's go to the requirement. The requirement says that we should prepare extract of financial statements for 31st December 2020 to account for the above transaction. We have only accounted for error. There are other transactions in the question we need to account for. Like, we need to show our depreciation in the statement of financial performance. We need to show the carrying amount in the statement of financial position. So if you don't do this, you lose some ticks as well. So we need to show that. So we'll move on with statement of financial performance. Then here we bring the year for 31st December 2020. Yeah, what do we bring here? We'll bring our depreciation here. And the depreciation is still out of straight line. Depreciation will still be the same, right? This one was for 2019. This depreciation was 2019 depreciation. But because it's straight line, 2022 will be the same. Hope you agree.
Yes, please.
So this will be the depreciation for 2020. Then we come to statements of financial position as at 31st December 2020. We bring our currency sign. Then yeah, we need to report the current amounts of the assets. So non-current assets, EPE. So we can show the workings in brackets. Yeah, the total amount is 8,000 here. We subtract here one depreciation. So the first year, which we didn't count, was 800. And we subtract here two, we are in 2020. So 2020 is depreciation, which is also what? 800 to give us the current amount for 2020. What will be the current amount?
6,400.
6,400.
6,400. Okay, thank you. So we are done with question two. Now, any question for me? You have a question for me on this? Something you want me to reiterate? You want me to explain further? Let me know. Okay. If there's no question, let's move on to question three. It's similar to question two, but there are little differences. Let's look at it. Reader, can you please continue for us? Lisa, Rita, can you read for us, please? Anyone?
Question 3.
Yes, please.
On 1st September 2020, 15 billion Ghana cedis was spent in acquiring motor vehicle to boost government projects. However, this transaction was included in the accounts as goods and service in the year 2020. Motor vehicle has a useful life of 15 years. The current accounting period ends on 31st December 2021, and this error has since not been rectified. In accordance with IPSAS 3 accounting policy changes in accounting estimates and errors, prepare extract of financial statements for 31st December 2021 to account for the above transaction.
Okay, thank you very much.
Welcome.
So with this question, the same thing I'll ask you. Is it a change in accounting policy, change in accounting estimate, or an error? Mm-hmm. Where will it fall under? Change in accounting policy, estimate, or error, and why? Hey, no one is talking. I thought this one would be much
Oh,
clearer.
That is error.
sorry, please. So it's just similar to the question two
Yes.
that
Yeah,
we
I know
just
it's
began.
similar. I just asked again just to see.
Okay, so it's an error, and
Yeah. What makes it an error?
reason being that it was a motor vehicle which we know it's PPE, but recorded as an expenses in financial performance as goods and services. Thank you, sir.
Okay, that's true. So my next question is, what is the difference between question two and question three? What's the difference between question two and question? What do you think is making the two different? Don't tell me because the figure is different. Don't tell me because this one is a train, this one is a motor vehicle. Don't tell me
The
that.
useful life.
The useful life. No, no, I don't want that one. Another one. What's making question two and question three different?
I think
Honestly.
the
Maybe
error is occurring in the same current year, unlike
Oh,
the question,
Um,
unlike the
which is the
sure.
same
maybe
current year.
I think
the
it's the
date
1st
for the
September.
Okay, no, so
acquiring the motor
no,
vehicle.
let's calm down, let's calm down, let's calm down. Take it one one. So let's address the first instance now. It says that the error is
I
occurring in the same year. So is the error occurring in the same year as the current period?
No, please, no, sorry, no.
Okay, so that's settled. There's
I
no. Next one, someone is talking.
I think the difference is the month for acquiring the motor vehicle. That is first
Correct,
September 2020.
correct. Yes, the month. The month. Look at the first one. The first one is in the year 2019. Look at the question three. On 1st September 2020. This should tell you that if you're accounting for the depreciation for 2020, you have to consider what's the number of months involved. Okay, so thank you very much. Let's move on to question three, the solution. So yeah, same thing we are going to do. Yeah, we need to press statements of accumulated fund. So let's do the same thing here. And here we bring the motor vehicle cost. The motor vehicle cost in this instance was 15 billion. So that will be 15,000 over here. Since I'm carrying million on top, I'll be 15,000 over here. The next thing we need to do is the depreciation. We'll calculate for the depreciation, which will be the 15,000. It will be the 15,000 divided by the useful life. The useful life by the question was what? 15 years. So we'll divide by 15 years. But bear in mind that the 2020 depreciation will start on 1st September 2020 and to end on what, 31st what, December. So how many months would that be?
How month?
4 months. So you
4 months.
multiply. Okay, so you're going to multiply it by 4 over 12. So the only difference between this and the other one was that yeah, the 2020 depreciation year is occurring on 1st September. So you're not going to consider a full year depreciation. You're only going to consider that of what? 4 months. So someone should calculate for us. What will be our depreciation now? What will be our depreciation now?
Three points. Three.
333. So let me ignore the rest. So it's
Three.
333. Okay, let
Oh,
me
it will be four.
it should be four.
Three.
Four threes.
Three.
Okay. So
Yes,
three
four
three three.
threes. Yes.
Four threes. Okay.
Yes, please.
Okay. So relax. What will be the net effect?
Success, please. It is three threes. I beg.
Okay. So three threes.
Yes, please.
Okay. What will be the net effect? So it'll be 2021.
It will be 14,666.
666. Okay. Then this is for the correction of error, but we need to show the other statements as well. So we need to show statements of financial performance, where we need to bring out current year depreciation. Let me just make the adjustments. Here is 2021. The depreciation for 2021. Yeah, bear in mind the depreciation for 2021 will be a full year depreciation, right? So yeah, it's going to be 15,000 divided by the 15 years. It will be a full year. So 2021 will be a full year from 1st January to Sorry, what did I just say?
1,000.
1,000. Okay, that will be 1,000. Now we come here, statement of, let me just copy, statement of financial position. Here we bring the cost of the assets, which was the 15,000. We'll subtract the first year depreciation, which was the 333. Second year depreciation is 1,000. What will be our answer?
13,667.
13,667.
13,667.
Okay, so let me see. 67, oh?
Yes.
Okay. So that's for question two. Question three, sorry. Question, you have a question for me on that?
Taxes.
Mm-hmm.
But please, you made mention about something in FR that for you to know that transaction
is affecting the policy or the estimate. It gives some borderlines. That's the three assumptions, whether it is the measurements, the recognition, and the presentation.
Yeah.
So with this one, isn't the errors conflicting with the policies? Since that if we don't recognize it well, it's an error, but at the same time, it is affecting the policy.
That's an interesting question, but you see, error, you
Yeah.
always know that you have made an error. That's different from
Mhm.
policy.
And it's when you don't follow, you don't recognize it well, it's an error. If you don't measure it well, it's an error. If you don't present it well, it's an error.
So
So
that's why we have the
don't you
policy.
feel like that?
So if we have a policy and you don't follow the policy, that makes it an error. Or
Error,
that
yes.
that will not
So
make
can we
it.
say that this question is affecting the policy?
No, it's not. It's not a policy. It's an error. It's a clear case. You can see it clearly.
Yes. Okay. Thank you.
You're welcome. Any other question? Okay, let's go to our last one then. The last question for the day, question four.
Question 4.
Yeah.
In in 2018, the Ministry of Health Supplies Units changed its inventory valuation method from weighted average cost to first in, first out FIFO to more accurately reflect the usage and flow of medical supplies in the procurement cycle. The impact on inventory valuation was determined as follows. At December 31st, 2016, an increase of 10,000 Ghana cedis. At December 31st, 2017, an increase of 15,000 Ghana cedis. At December 31st, 2018, an increase of 20,000 Ghana cedis. The statement of financial position performance before adjustment for the procurement unit was, shall I read that one, please?
Um, requirements.
Re- required. Prepare the statements of financial performance with adjustments in the updated accumulated fund statements for each year.
Okay. So first things first, is there a change in accounting policy, estimate,
Yes,
or error?
it's a change in accounting policy
Why?
because they move from weighted average cost, that's the WAC, to FIFO. Yeah, FIFO. That is the first thing first. So they've changed the way they value their stock from the weighted average method to the first in, first out method.
Okay. Yes, you can clearly see it as well. So that's fine. So let's go straight into question four. Yeah. The question four gave you some instructions, and you always have to follow the instruction given to you. Statement of financial performance. They want us to prepare the statement with the necessary adjustment. So meaning we have to look at the adjustments you are going to make. Now, this is the statement they have given to us. They have given us a statement over here. You can clearly see this statement, which we have been given. It means that we are going to redo the statement again. By here, we are going to now effect in the new changes which may occur. First, now ask you is that the inventory, which of the items do you think over here to affect? Which of the items here do you think to affect?
So the inventory for 2016, that's 31st December 2016, is going to affect 2017's
No, I'm not there yet. I understand you are not
um
there yet.
oh,
I'm talking about
okay.
statement of financial performance. Which item will it affect? Will it affect your revenue? Will it
Okay.
affect cost of sales issued? Will it affect gross surplus? Will it affect administrative expenses, distribution and logistics? Which of the item will it affect?
Sir, please come again with the question.
So I'm saying which of the items in a statement of financial performance will it affect? So in a statement of financial performance, you can see revenue, you can see cost of sales, supplies issued, you can see gross surplus, you can see administrative expenses. So which of the items there will it affect? Will the inventory affect?
Which will affect the cost of supply issue.
Yeah, so the cost of supply issue. So meaning that this cost of supply issue here, we need to
Yes.
adjust it with the effect. So we'll do a separate workings for that. So as part of our workings, we need to do
Yes.
cost cost of supplies issued. So yeah, it's for 2 years, 2018, 2017. So we first bring as per question. We first bring the figure they brought to us in the question, which is 100,000 and 80,000. So 100,000 and then 80,000. So once we have done this, the next thing we need to do is to start with the adjustment. Now the adjustment, inventories has two major adjustments. It will affect opening inventory and then closing inventory. So let's divide the adjustment into two. Let's do the adjustment for just the opening inventory. Then we'll do the adjustment for the closing inventory. So let's first start with the opening inventory. Now bear in mind that yeah, they said 31st December 2018, because of the change in the policy, there will be an increase of your inventory by of 10,000. Meaning your inventory will increase by 10,000. Meaning that if your inventory is increasing, this means to affect your closing inventory of 2016. And if it's affecting closing inventory of 2016, it will affect opening balance of 20 what? 17. So yeah, it will affect the opening balance of 2017. Now, once it's affecting the opening balance of this 2017 figure, you have to ask yourself, am I supposed to add it, increase in the opening inventory, against your cost of supplies issued? Yeah, the same as cost of sales in effect. Are you supposed to add or you're supposed to subtract? Are you to add or subtract?
Mhm. So that is here
Yes.
for opening stock. We normally add, and now we added, and it is an error. So we need to subtract
Please, you
the
don't
ten
need
thousand
error
from
also.
the cost of supplies in
Hello.
2017.
Yes, sorry for cutting you short, but
Subtract.
you are not doing error also, so you are not going to subtract. So we are now recording it. You have made a change in the policy, and it said that because of the change, you have to increase your 31st December balance by 10,000. And we said if you are increasing the closing balance of 2016, it will affect the opening balance. This means that your opening balance, you are supposed to what? Increase it as well. Because when you are doing your cost of supplies issue, with your opening balance, you add your purchases to it. So opening balance here will be added, not subtracted. Please, you get it? It will be added, not subtracted.
Yes, yes. Sorry, I didn't read that part.
Okay.
Yes,
So
yes,
yeah, it will be 10,000. We'll
yes,
rather add. We'll rather add.
yes. Add to 80,000.
Okay. Then we'll look for that of 2017, 2018. So 2018, what will be the its opening balance? What do you think will be its opening balance in this case? And how did we get that? What will be the opening balance for 2018?
15,000.
15,000. How do you know that
Yes,
15,000 will be the opening balance for 2018?
because the closing balance for 2017 will be the opening balance for 2018.
So you're right.
That is the 31st of. Yes.
Yeah, so that's true. Thank you very much. So we are going to add the increment in that opening balance figure to what we have as part of our cost of suppliers issues. And we'll get 115, right, for this?
Yes.
115,000. And then this will be 90,000. When you're done, we'll come
So,
and deal with the closing inventory. So with the closing inventory too, bear in mind 2017 will affect 2017 closing. So this 15,000,
yes.
are we supposed to add the closing balance to the cost of supplies issued, or are we supposed to less?
We are supposed to
You are supposed to
less
less it.
So why are we less and not added?
because it's the
We need
closing
to increase
balance.
closing stock.
So we are increasing closing stock. And no closing stock here in your calculation of cost of sales. It was a negative item. You pick
Yeah.
opening inventory,
Yes.
that takes you less.
Less closing stock.
Less closing.
So yeah, that's the reason why we need to less. So when we come to 2017, here we are going to less the 15,000.
Additional from, yeah,
Yeah,
15,000.
15,000. Yeah, in this case, let me convert this. Then when we come here too, we'll do same, but here it's 20,000 in this case. So less 20,000.
Yes.
Then we'll subtract for each case. So let's subtract them respectively. And what will you get?
95,000, 75,000.
95,000, 75,000.
Sharp, sharp, sharp.
Okay, so when we are done, we'll prepare the new financial statement again. So we just have to prepare statement of financial performance for the years ended 31st December. Then we bring the respective year here, 2018, following how the question did it. So 2018 and then 2017. They brought revenue first, so we bring our revenue. Just look and write. So yeah, 250,
Look at
200, 250, 200. Then we bring our cost of supplies issued, the new figure we now have now. These are the new figures. Let me copy and paste them here. And then we look for our gross profits. So give me the gross profit figure. One less. Let me bring the less here. Just showing that you have to less this. One less, what do you get?
155,000.
for 2018.
55,000.
155,000.
Yes.
That was for which year? 2018, right?
2018, yes, please.
Okay, 2017.
125,000.
125,000.
25,000. Okay.
Okay. Then we'll come to the rest. We just look at it and write it. Admin expenses. So admin expenses. That was 60, 50. So 60,000.
50K.
60,000. Come in. 60,000 here. And then here was 50,000 off. 50,000. come to the others. The next one was what? 15,000 and 25. 25. So we bring that there. Then the name was distribution. The name is distribution and logistics. So distribution and logistics. So we'll calculate that. What will be now is this one is gross surplus, sorry. Then we bring the net surplus. So what will be our net surplus?
70, 60.
70. Are you sure?
Yeah, 70,000 and 60,000.
And 60,000. Okay. Then the question said we should do the updated statements of accumulated fund. So do the statements of accumulated
20.
fund for the years ended. So 2018, 2017. So yeah, we'll bring the opening balance first. And we're giving the opening balance for 2017, right? Which is 300,000,
Yes,
right?
please.
So we'll just write
Mm-hmm.
300,000. Then yeah, so we have to do the prior period error. So we have to find the prior period error. And yeah, the prior period error was in relation to 2017. So that's
Yes.
for 2017. So in correcting the prior period error, the inventory, we have to look at the opening inventory and closing inventory. And bear in mind here, you're adjusting it against accumulated fund, which is the same as your accumulated surplus over the period. So here, the inventory, which is made up of your opening inventory and closing inventory. You can do it this way. You can combine the two and work with it, or you can do them separately. I don't know which one you really prefer. Should we do it separately or we should combine?
Combine.
We should combine. Okay, so the prior period error here, the
Yes.
inventory. There are two things we bring
Opening
here,
and closing.
the opening and closing. So we just look for the difference for between the two. Yeah, yeah. So yeah, the difference between this and this will be what? 5,000, right? For
Yes.
2017. That will be for 2017. The difference between opening and closing for the first one will be 5,000, right? And then 2018 will be what?
Yes.
2018 also will be what? 5,000. But bear in mind that yeah, in the first instance, the opening inventory was more than the closing. The opening inventory was less than the closing. Opening inventory was 10,000 here. Closing was 15,000. So the difference gave us 5,000. So this is supposed to be a negative difference. Are you okay? You understand what I'm doing? Or I should do it separately.
Yes, but
Yes.
I don't know. Inventory in each effect is a current asset. So when the opening is less than the closing, negative is what I don't get you. So if you can elaborate more on that.
You let me do it separately. I want to avoid a lot of explanation. Let me do it separately. Let's start with the opening. So opening, we are correcting the error. So opening was supposed to be increased in 2017. So if you're adjusting it, yeah, bear in mind, you're adjusting it against your surplus, against your profit. So if you're adjusting it against
Yes.
your profit, are we supposed to add or subtract?
You're supposed to.
Are we going to add or subtract?
Please, you add.
We are going to add.
Yes, please.
Why are we adding?
Yes. It's supposed to increase our profit so that when we less the closing stock, it reduces it to the actual level.
And we have to add to increase profit.
Yes.
So when we,
Yes.
if you are adding, if you are adding here means it's supposed to increase our profits. Meaning our profits will have been understated if not for the opening inventory. Right? Do I get you?
Yes.
Okay.
Yes, please.
So which figure are we adding? What's the opening for 2017?
The opening for 2017 is 10,000.
10,000.
Yes.
And come on, are you sure we are adding? Is everyone okay why we are adding?
Yes.
No,
Mm-hmm. Why? So bring your viewpoint. Why do you think otherwise? Someone said no.
I don't think otherwise. I don't understand what you are saying.
Okay, I'm looking at the effect. Let's look at the effect. Opening inventory. Opening inventory. Opening inventory. We need to increase opening inventory by 10,000, which we didn't do
Yes.
in 2017.
Yes.
So if you're accounting for, this one is not proper period error. It's proper period adjustment. This one is not an error. It's an adjustment. Actually. Okay. So where else I had? So it's opening inventory should have been recorded in 2017, but as opening inventory, but it was not recorded. What will have been the effect
Mm-hmm.
on 2017? Will it, since we didn't record, did it understate your profit or it overstated your profits?
Understated.
Why do you think it's understated?
Yes.
Uh,
Because the 300,000 is. Sorry.
the 10,000 is an asset which need to be added to the accumulated fund to increase our profit.
You have gotten me confused. So I want you to explain from the statement of financial performance perspective. I understand you, but I want you to explain from the statement of financial performance perspective. What is up? Yeah, go ahead.
Okay, let me take it from this angle. I'm thinking that from statement of financial performance, the opening stock will affect our cost of sales, which here it will affect our cost of sales, which we have added it to our opening stock, then less it from the gross profit. So if we are reinstating it, then it means that we've already deducted it from our our income revenue. I'm mixing the the abstract and this thing, but I hope you understand.
Yeah, I understand you. Proceed.
Yeah. So now that we want to reinstate, readjust it, we should add it back because we already deducted it from the statement of financial performance as part of our cost of sales from
No,
the
what I don't
revenue.
understand is that you say we deducted. How do we deduct?
Yes, because we added it to our opening stock. We added it to our purchases.
No. Relax, relax. It's not an error. Okay, it's not an error.
It's
Relax.
not error. It's
It's
not
an
error.
adjustment.
Yes.
Okay,
Your explanation is moving in error direction.
okay.
It's an adjustment you are making. That's why I claimed the error initially. It's an adjustment you are making. So anyone who wants to help, you've tried. Your explanation is more on point.
So
Yeah, anyone.
it
You're
means
helping.
that when we use the work method, we arrive at a surplus of 300,000. By saying that because we change from the work to the FIFO, it means that this 300,000 is not having a 10,000 of opening stock in it.
Yes.
So we have to go and add it back and there's the 15,000, which is the closing stock from it to get the actual accumulated fund for 2017 since we have changed our policy.
So since it wasn't passed, did we understate the profit in 2017 or we overstated?
Yes, we understated it, but the closing stock will come and reinstate the actual profits that we are supposed to get in 2017.
Are you sure?
Yes, because the closing stock will be lessened it from the
We are doing opening,
because we are going to
closing.
add the
We are
opening.
doing opening.
Yeah, so yes. Also, I was just adding the other one to it. Sorry, so the profit here has been understated by the 10,000.
Mm-hmm. Are you sure it's
Yes.
understate?
So we need to add it. Yes, we need to add it back. When we add it back, then we less the other what do you call it? The closing stock. It will give us a true reflection of the accumulated fund.
Are you sure you're supposed to? It's one rather
Ah,
reflection.
please, what was the question?
The question is using the opening inventory, the adjustment. Are we to add or subtract? Yeah, go ahead. Hanisa, go ahead.
Okay, so per my view, this was an increase which is supposed to happen in 2016, which is a closing stock, and it will become an increase on an opening in 2017.
Mm-hmm.
In this case, it means 10,000 supposed to be included in 2017 calculation as an opening inventory, but it is not. Which
Mm-hmm.
means and when you are preparing your financial performance, opening stocks needs to be added, but it is not part. So it means it has been understated. And in this case, anything that understates the profit, you need to
What has
add
been
it back.
understated? What has been
The
understated?
opening inventory.
Okay, proceed.
And anything that understates the profit need to be added back.
You've changed it at the last end. You know why you're not getting the effect? Hanisa, do you have anything to say? Okay, so let's take our time. Let's analyze it bit by bit. Opening inventory has been understated. You agree?
Yes, please.
So, opening inventory has been understated.
No, we don't agree.
Okay, why don't you
I
agree?
don't think it's the opening inventory that has been understated.
Okay, what has been understated?
The profit.
Yes, I'm starting from there. I'm starting from opening. I'm
Okay.
building it. So, opening has been understated, right? Do you get it now?
Yes. Yes.
Now, what will be the effect? Will cost of what's the name?
Cost of
Cost of
sales.
supplies. Let me use the name given to us. Cost of supplies. Will it be understated or overstated? If any value is
Understated.
understated, will it be overstated or understated? It will be understated, right?
And yes, please.
Okay. And now, if cost of sales is understated, what will happen to your net
Gross profit.
surplus? Net surplus or profit? What will happen to
Uh,
our profit?
it will be overstated.
It will be overstated.
Overstated.
Do you understand now?
Yes. Yes.
Now, since it has been overstated, how do we correct the error? And it's not an error. How do we do the
We
adjustment? Do we add or subtract?
we less it.
We less it. Ah, thank you
We
very much.
less it.
That was all I was waiting for. So we less. You're not rather adding, you're
Yes.
less.
Yeah, less. Okay.
Please, do you get it? Those who were with the adding, do you get the reason why we are now lessing?
Yes, yes.
So let me do the closing as well. So what about the closing inventory? So closing inventory for 2017 was 15. The effect on is 15. So this 15,000 too, let's analyze it. Are we adding or subtracting?
We are
This
adding.
time around, you do it for weighted. Are we adding or we are subtracting?
We are adding.
We are adding. Why?
Yes.
Explain.
Because the closing stock was supposed to be less from the other cost of sales elements to get a lesser cost of sales. But since we didn't less it at that point, it means that the cost of sales was higher than it's supposed to be. So it was like cost of sales is more of 15,000. So we have to go and add it back to less it. We need to reduce it from the 15,000 to zero just to cancel.
Do you agree? Do you agree? So yeah, you are right. You are right. But yeah, there's one thing I want to let you know. Yeah, we don't need it. Yeah. Why don't we need it here? It has been accounted for in the 2017 already.
Okay. Yes, yes, yes.
Are you okay? We have already done it in the 2017 already. Bear in mind, this one, the opening balance has not been corrected from it. The 2016, if you realize in our question, the 2016, we didn't touch anything. The opening balance, we didn't touch it. So it has not affected the 300 of the accumulated profit. That's why we had to account for it over here.
Okay.
So in doing that, yeah, we just look for the difference, which is the 290, right?
Yes.
Then, so this is what we call restated balance. This will be our restated balance. Then we'll bring the net surplus for that period, which is 60,000. So that will give us
290 plus 60 will give us 350,000.
350,000. And usually we'll say opening balance becomes closing balance, right? Opening balance will be the closing balance, right? Closing balance
Yes.
becomes opening balance, right?
Yes, but we have to add the profit to it.
Yeah, so yeah, this 350 here will be the restated balance for 2018. Why? We have
Yes.
already corrected the error
Yes.
over here. If you are doing it, you have to show us what should have been the original figure, what should have been the error, and what would have been the restated balance. If you don't do that, then you lose six. So we have to go back and do that. Going back and doing that, how are you going to do it? You're just going to pick the opening balance, which was the 300,000, and we are already taking the profit
The
for
wrong profit.
2017, the wrong profit for 2017.
Yes.
We'll add it to the wrong profit in 2017, which is what 55,000.
Yes.
So if you add it to give us 3,055,000 in this case. Then now we now come and correct this error to give us the 350 back. How are you going to do this? You start again, opening and then the closing. So the opening, you have established that the opening you are going to less or subtract. Less or add. You have established you are going to less, right?
Yes, you are going to less.
So what's the opening for 2018?
Will be the closing for 2017.
That's 15,000.
Yes,
Yes.
So
please.
be the 15,000. So be the 15,000. So coming. Then we'll do that of the closing inventory. So the closing inventory was what? 20,000, right?
Yes.
And now we are going to add. Bear in mind that 2017's own was already recorded. That's why we didn't do that. Yeah, we have done the wrong one. So we have to still bring the closing for this year. So that will be that. So when you subtract, you're supposed to get your 350 back. Will you get it?
No.
No.
You're not getting, meaning we have made an error. What will you get?
You get 360.
350.
360.
Yes, please.
Difference of 10. Okay, so where did I go wrong? Okay, let me analyze it. I mean, I'm thinking it's supposed to be rather 290 plus the error. Yeah, so that's where we had a mistake. It's supposed to be 290 rather plus the 55,000. Did you get it?
Yes.
So 290 plus the 55. That one will rather give us what?
345.
345.
345.
And that will give, when we add, that will give us the 350 back, right?
Yes.
Yes.
Then we bring the 70 here. When we add, what do we get as the closing balance? Balance carried.
420.
420. Okay. So that is the end of this question. If you have a question, let me know. Yeah, do you have a question? Question, please.